Just flipping through the agenda briefly, we'll do an introduction and touch on some of the highlights. We'll review the financial highlights for the period, discuss some of the capital management initiatives, look at the operations in South Africa, Australia, and the V&A waterfront. Those are essentially the three major components of, or that contribute to our distributable income today: South Africa, Australia, and waterfront. We'll review some of the property investment activities during the period, touch on the acquisition of the ABSEC and Tiber portfolios, briefly discuss the prospects, and as I mentioned, the annexures are there for your information. Briefly, Growthpoint remains the largest listed REIT, no longer property loan stock company, but REIT on the JSE. Property assets just over 63 billion. And that includes 100% of Growthpoint Properties Australia. We own 63.5% of that, and we consolidate that, so that number includes 100%. And then our 50% share of the V&A waterfront that we obviously own in partnership with the PIC on behalf of the Government Employees Pension Fund. Our market cap at 31 December 13, the half year, was 47 billion. Share price at that time was 24.28. Growthpoint today owns 388 properties in South Africa, 49 in Australia through the Australian subsidiary, which I mentioned is 63.5% owned, and the 50% in the V&A. Our retail portfolio at December was valued at 15.1 billion. The office is at 17, industrial at 8.5. That should give you just over 40 billion, I think, for the South African assets ex V&A. Australia, 16.8 billion. That's about $1.8 billion of property in Australia. And then the waterfront at 5.7 billion. Like to always differentiate ourselves a little bit in terms of that last comment. Not everybody, I think, understands the extent and nature of the business, but we are a fully integrated, internally managed property company where we do all aspects of property management, letting and leasing, facilities management. Everything gets done in-house, and we have 460 staff across the country, offices in Durban, Cape Town, and Sandton, and then obviously at the properties throughout the country, whether it be shopping centres, office parks, or industrial parks. Some highlights for the period. The successful conversion to a REIT. The last annexure 34, does give a little bit of detail on the nuances and the difference between the property loan stock and the REIT, as well as the nature of the distribution, which today under the REIT regime is actually a dividend, a taxable dividend, as opposed to the interest nature of the distribution under the old PLS regime. The distribution per share is up 8% to 78.5 cents, above the guidance that we gave at the end of the financial year end in June, where we guided for about 7.2%. So very pleasing from our side to be able to come out with better prospects than what we had guided before. We invested another 832 million into the Australian subsidiary during the period. The total cost of our investment to date there now is about 4.3 billion rand, and the market value at the share price and at the currency exchange at year end was 7 billion. So quite a handsome capital profit on that investment. During the period, we raised 976 million of new equity through the distribution reinvestment plan, and that gave us a 67.7% participation by shareholders who elected to reinvest into shares rather than take the cash distribution. We launched an American Depository Receipt program in October 13, and then towards the end of the year, just before the end of December, when we all went on our holidays, we were successful in the bid to build a new head office for Discovery. There was released, some information on that was released by Discovery about 2 weeks ago. And our share of that is 55%. So we're actually in a 50-50 joint venture on the development of the asset with Zenprop. But on the ultimate ownership of the asset, we will own 55% of it, and Zenprop will own 45% of it. Our capital commitment there is in the order of 1.4 billion. The total project size in the order of about 2.7, 2.9 billion. Post year end, we completed the acquisition of the ABSEC portfolio. You might recall that we actually announced this clearly before the December half year. But we completed that. The effective date of that transaction was the 1st of January 2014. And that property portfolio value was 1.3 billion. And then just 2 days ago, we finally implemented and completed the Tiber transaction, where the effective date of that was the 1st of March. And that was a 6.5 billion rand acquisition of a property portfolio from Tiber. If you look at the growth in distributions over the last 4 years, you can see, ranging between 8.1% on the high end and 6.1% on the lower end. As I mentioned, slightly ahead of the guidance that we gave. And when we get to the prospects later, I think most of you who saw the SENS announcement will recall that we also confirmed that we look to continue or look to show 8% growth for the full year ending June 14. This slide just shows us how the assets and market cap, NAV per share, as well as share price has grown over the last 5 years. Unfortunately, I guess due to factors outside of our control, you can see the share price taking a bit of a dip, the orange line at the top there. That is reflective of the major interest rate move that we saw in May last year, where long bond yields rose from about 6% to 8% in South Africa. And on the back of that, the listed property sector yields corrected by maybe not quite as much. That's almost the 6 to 8% is almost a 30% correction, or just over 30% correction. Whereas the listed property sector didn't quite correlate 100% with that. I think the sell-off was more somewhere between a 20-25% in listed property values. One of my personal missions, and I know that many of the analysts are sitting here today, they'll probably have a go at me or have a dig at me, but there is a personal mission on my side to try ultimately de-link the valuation of listed property from the bond yields, or certainly the correlation, that the correlation shouldn't be as strong as that. It's, in my mind anyway, bizarre to think that from 1 week to the next, our business is worth 30% less just because bond yields rose by 30%. But that's a debate for another day. If you look at the financial review, as I mentioned, the 3 major contributing factors to our distributable income. Firstly, the South African business grew distributable income from 949 million to 1,131 million. That's about a 19% growth. The Australian business contributed 232 million, up from the 186. That's about 24% growth. And then the V&A Waterfront at 157 million, up from 150. It's about 4.7% growth. The 18.3% growth in absolute quantum of distributable income obviously gets diluted down to the 8% once we take into account the additional shares that were issued in the capital raise in May last year, as well as the shares for the distribution reinvestment plan, which were issued in September. This is a slide we put in last year, I think, for the first time, but interesting just to see the sharing, if you want, of the wealth created by the organization. 180 million, or 6% of the total, went to employees. This is pretty much how all these stakeholders shared. Employees got 6%. The shareholders and the old linked unit holders received 1,520 million. That's our distributions that we'll be paying out. That's about 50% of the total. The minority shareholders in Australia get about 4.2%. The providers of debt, many of whom are in the audience here today, and I thank you for your attendance and for your support, they received just on about 30% of the total, 897 million rand worth of interest. And then 285 million rand, up from the 238 million rand, was paid across in taxes. In essence, this is rates and taxes that gets paid across to the different municipal councils. Quick look at the summarized income statement. Gross property income grew at 6% to just over 3 billion for the half year. South Africa at 3.9% and Australia at 13.2%. Property expenses grew at 8.4%, South Africa at 6.9%, and Growthpoint Australia property expenses grew at 19.2%, leaving you net property income up 5.4% at 2,374 million. Our other operating expenses, or call them head office expenses, grew at 10%. A slight reduction in South Africa to 77 million, down from 80, and an increase of 48% in Australia. Looking at percentages is always, quite. You need to be careful, I think, when you look at percentages. In that, if you look at the absolute quantums, the overhead expenses in Australia grew from 29 million to 43 million, so that's only about a 14 odd million rand growth, but it shows up as a 48% increase. Put that into context, 14 million is about $1 million in the Australian, in context, just $1.2, $1.3 million, not very significant, but I'll talk to that shortly. Finance costs in South Africa down 9%, I think indicative of the fact that we sat on higher cash balances and lower debt balances post the capital raise. We raised the 2.5 billion rand of new capital in May last year, but we have only just paid out the bulk of that money on the Tiber transaction 2 days ago. The Australian entity interest costs also down by 0.8%, also reflective of lower average debt balances. We'll talk to Australia later, but Australia also had a capital raise during the period and raising about $150 million. Finance income, on the other hand, was up 36%, reflective of exactly the same higher cash balances that we held during this period, and leaving us with distributable profit up 18.3% at the 1.52 billion. The minority interest in Australia was up from 125 million to 140 million. If we look at our expense to income ratios, pretty stable. Certainly in South Africa at or around the 28% mark. The mix within that as well, quite stable, 24.6% property expense ratio and 3.4% operating expense ratio. In Australia, the property expense ratio rising slightly from 11.2 to 11.7, indicative, I think, of the continuously changing mix there of the portfolio between offices and industrial. And then the 5.8% operating expense ratio growing from 4.3 to 5.8. In the main, that's indicative of the move to a new head office building in Melbourne of our Australian team, but also incentives to management in terms of the short-term incentive and long-term incentive scheme that we implemented for management in the Australian business. V&A running fairly constantly or consistently at or around the 31% mark. On the balance sheet, consolidated, property portfolio value 57.4 billion versus the 54 at the financial year in June, up 5.9%. South Africa up 3.6 to 40.5, and Australia up 11.7% to 16.8. The waterfront wasn't revalued at this time. Waterfront year-end is March, so that revaluation takes place in March, and you'll see any movement in the waterfront valuations come through in our year-end numbers. Cash and cash equivalents, 1.6 billion of cash. The South African entity, 1.5 billion, and Australia, 88 million. The sad news is the 1.5 billion is all gone. We paid it out to Tiber and their shareholders on, where are we today? On Monday. Nominal borrowings, 19.5 billion, fairly consistent there with the previous reporting period. South Africa at 12.6 and Australia at 6.8 billion, and leaving us with shareholder or linked unit holders interest, call it NAV, at 40.4 billion. On the capital management side, very conservative balance sheet at December, 24.2% loan to value ratio for the South African business, 40.3% for the Australian business, and for the group on a consolidated basis at 28.5%. Interest cover in South Africa 3.4 times, 2.5 times in Australia, and for the group as a whole 3.1 times. Now clearly this number is likely to change immediately after December, or certainly after the payment to Tiber at the beginning of this week. And it's likely at the year end that we would be moving back up towards about a 34% loan to value ratio on the South African balance sheet post implementation now of the ABSEC and Tiber transactions. Very well diversified source of funding. So if you look at the makeup of our current total debt of 12.6 billion, 6.3 of that is traditional bank debt. We have in secured form. 1.4 billion is secured institutional funding, so almost conventional debt, but not from banks, from institutional institutions. Unsecured bank debt of 1.5 billion. So that gives you the total then of our traditional bank debt, which makes up 73% of our total funding. And then the debt capital markets, we have corporate bonds in issue of just over 3 billion and short-term commercial paper of 400 million, which is then 27% of the total debt in the form of debt from the capital markets. If you then look at the mix between secured and unsecured debt, we're currently sitting at 61% in the form of secured and 39% in the form of unsecured. I think we mentioned a couple of years ago that we have a strategy to try and move that closer to a 50-50 ratio between secured and unsecured, and also to potentially tap the debt capital markets for a greater percentage of our overall funding. During the period on the capital side, we, as I mentioned, raised 976 million in new equity via the DRIP. We bought back 16.5 million shares from one of our empowerment partners, Patsima Properties, where we refinanced their debt on the original deal we did with them in 2006. And those shares were bought back at 21.50 Rand cum distribution, 20.74 Rand on an X basis. Just yesterday, I think we announced that we finally completed the share buyback, if you want a specific buyback of a further 17 million shares from two of our empowerment partners in the AMU Trust. The AMU Trust was the first empowerment deal that Growthpoint did in 2005. And one of the parties had a desire to exit the structure, if you want, and we as Growthpoint facilitated that and bought back those shares at exactly the same price, 21.50 Rand cum distribution, or 20.74 Rand X. The ADR we launched in October. We don't attract or attach a tremendous amount of value to this. I think it just ultimately is a view that that should enhance liquidity. I don't think since between October and now there hasn't been too much activity, but we hope that in future we'll see some more activity on that side. And then due to the anticipated or pending ABSEC and Tiber acquisitions, we kept significant facilities during the period, and I'll talk to that a bit later when we talk to the ABSEC and Tiber transaction specifically. But at December, we had unutilized committed facilities of 2.7 billion rand. The weighted average term of our debt is 3.6 years. The weighted average term of the fixed interest rate profile is 4.5 years. The weighted average interest rate is 9.5%, and the percentage of debt that was at fixed interest rates at December was 86.5%. Regarding the Discovery head office commitment, we have successfully secured a separate debt facility for that in the form of a balance sheet loan. Moody's has maintained Growthpoint's credit ratings with a stable outlook. I know that they've recently performed a review, and possibly during the course of this week there might be some further announcements from Moody's following that review. Moody's also concluded on their review of the Tiber and AppSec transactions that, in their view, those transactions enhance the overall quality of Growthpoint's cash flows. Just on our treasury policies, I think these were reconfirmed by the board. Firstly, that we will ensure that cash flows from operations plus available credit facilities will exceed our committed cash outflows and debt maturities over a 12-month rolling period. And in essence, that we will have a minimum of 75% of our interest rate exposure hedged at any point in time. If we move to the operations, contributions to net property income, 67.4% coming from South Africa, 25.8% from Australia, and V&A Waterfront making up about 6.8%. If we look at the South African operations, net property income grew to 1.716 billion. We have 338 properties in the South African portfolio, and the portfolio value 40.6 billion. So a pretty stable picture here over the last 3 reporting periods in terms of the contribution from the different sectors, retail, office, and industrial. Clearly, following the Tiber and AppSec acquisitions, again going forward, you're likely to see a greater contribution to the net property income coming from the office sector. If we analyze the net property income in a bit more detail, gross property income for the retail portfolio grew at 3%, office 3.5%, and industrial 6%. The property expenses, retail grew at 4.1%, office at 6.5%, and industrial 13.9%. That results in net property income from the South African business growing at 2.9%. If we adjust for the impact of acquisitions, developments, disposals, you get to what we call the like-for-like net property income number, and that grew at 6.4%. Retail at 6.7%, office at 5.9%, and industrial at 6.8%. Some of our key performance indicators: overall vacancies at 4.6%, marginally up from the 4.4% at the financial year end in June. Total arrears at 43.7%. We always have arrears spike in December relative to our June number. But if you compare that to the half-year 13 number at 48 million, you can see that it's actually down from what it was at the comparable December period. Provision for bad debts, 14.5 million. Bad debt write-offs of only 2.3 million. And again, if I look at the arrears situation, it is indicative of a fairly healthy book and certainly a fairly healthy customer base that we rent property to. The average in-force escalations in our lease book is 8%. Our renewal success rate was 68.3%, slightly down from the 70% before. The weighted average renewal growth rate was 3.5% on leases that have been renewed. The future escalations on these new leases that we signed was 8.3%. Employees 460, and the net property income per employee 3.7 million. If we look at the retail sector specifically, the portfolio value increased by 11%, which is driven mainly by the redevelopments and extension to Brooklyn Mall, Colonnade, Northgate, and Warmer Park. During the period, we also sold some retail properties, being the Gustav Voigt's asset in Namibia and Centurion South Lake in Centurion, as well as Atlas Mall. These were sold in the fourth quarter. Net property income increased only marginally due to the loss of income from the properties sold, while the income flow from the redevelopments and extensions only started in Q4 13. So a slight imbalance there between the capital having been spent, but the revenue only in for a shorter period than the full 6 months. Like-for-like growth in retail, as we mentioned, was 6.7%. The overall vacancy factor deteriorated to from 2.9 to 3.3, and again that was mainly driven by the second-tier properties. The vacancy in the top 10 centres remains at 1.9%, and we expect that to decline as vacancies under development have now been let. The arrears have increased marginally in rand value, but remain constant at 12.2% of collectibles. However, we have pushed up the bad debt provision a bit in the retail portfolio in anticipation of deteriorating trading conditions. The renewal success rate at 81.9%, with weighted average renewal growth of 5.7% in the retail portfolio. Turnover growth at the top 10 centres was 5%, but that was severely negatively impacted by Waterfall Mall in Rustenburg, which is still suffering the consequences of the labour unrest and mining unrest in the Rustenburg area, as well as the introduction of new retail competing with our centre in that area. Waterfall Mall, I think, year on year, was negative 7%. The remaining centres recorded 7% year on year growth. In the office sector, net property income growth reflects the challenging market conditions and has also been affected by the sale of 7 properties during the past 12 months at a capital gain of 189 million. The market conditions have remained challenging, and vacancies have increased from 7.1 to 7.5. Recently completed developments, however, which are currently being let, accounted for 1.2% of those vacancies. Letting activity in the period, 126,000 square meters was let. 72,000 of that space was renewed, and 54,000 of new space was let during the period. The renewal success rate is reasonably stable, notwithstanding the tough conditions in the office sector. Arrears are exceptionally low at 4.4% of collectibles, and well below the December levels of the past 5 years when arrears traditionally peak. The focus, I think, for the office sector over the next 12 months is going to be the integration of the ABSEC and Tiber portfolios into our office portfolio. We're also taking on in the order of 60 odd people as part of those 2 transactions, and most of the people are already in our premises, and we hope to integrate those businesses into ours as soon as possible. On the industrial side, vacancy and arrear levels are below the industry average. The diversified nature of the industrial fund has resulted in a balanced performance in a challenging environment. Increasing acquisition opportunities at more realistic yields is what we expect going forward. Certainly in the last 6 months, we've been particularly unsuccessful in our efforts to acquire further industrial assets, where quality industrial assets have been sold in anywhere between 6.5% and 8.5% yields. Renewal success and vacancy rate was negatively affected by one single large vacancy, one property, 30,800 square meters, where a tenant vacated as the lease expired. And that in itself accounts for about 1.5% of the vacancy. So we're pretty optimistic of reletting this quite soon, and therefore would look for vacancies in the industrial, vacancy factor in the industrial sector to come down to below 3%. Strategy on industrial is to convert the dirt. Engelbert's here, he'll be able to tell you a bit more what he means by that. But in essence, what he's referring to is the fact that we did, over the last 12 odd months, we have been buying some industrial land for development. as well as the fact that we do have some older industrial properties in our portfolio in traditional well-established industrial nodes such as Epping down in Cape Town, where it's possible to convert some of those older properties into newer generation, more modern properties, and by our estimation get better returns out of that than buying new product at 7 and 7.5% yields. Further to the strategy is to remodel and add value to the tail end of the portfolio. That's pretty much what I've spoken about. And then maintain the status quo in respect of the core portfolio with a specific emphasis on vacancy levels, arrears, and renewal growth. Briefly onto Australia. Net property income up at 658 million from the 585 million. The split between office and industrial, 47% coming from the office portfolio and 52% from the industrial portfolio. Number of properties has grown to 49, and the value in rands of that portfolio now at 16.8 billion. KPIs for the Australian business, the vacancies are sitting at 0.4%, total arrears at 1.9 million rand. The average in-force escalations in Australia sitting at 3.1%. Our renewal success rate there is 93.5%. The weighted average renewal growth rate was a negative 8.2%. There were 3 leases that were renewed during the period, and one in particular being a call center type operation in Adelaide where Westpac were the tenant. That was the end of about a 10-year lease, and we did have some negative reversion on that renewal. It was renewed for a further 7 years. 5 years, the big one. Weighted average future escalations, 3.4%. We only have 12 employees in our office in Melbourne, and the net property income per employee there at 54.8 million. I think GOZ continues to perform well. We had 4.4% growth in distributions out of the Australian entity, with a forecast of 9.6 cents for the second half, which will give you 4.4% for the full year. At the current share price of $2.42, $2.44 in that range, still trading on a forward yield of around 7.7 to close to 8%. We acquired $77 million worth of properties during the period. And the property fundamentals in Australia remain very, very solid. So we've got a high quality tenant base there. It's diversified across the office and industrial sectors. We've got properties in every Australian state across the country, as well as the Australian capital territories. The weighted average lease length at 6.6 years. It's quite nice in Australia where the average, well not the average, but 10-year leases are quite the norm in Australia, whereas in the South African market, everybody would give their front teeth for 10-year leases. The vacancies are negligible, and the lease expiry risk in the short term is also similarly negligible. We've really fixed the balance sheet of the Australian entity over the last 3-odd years. You may recall when we bought that entity, it had gearing at over 80%. We initially invested $200 million and brought the gearing down to just over 50%. And systematically, as we've grown that business by introducing a mix of new equity funding and debt funding, we've brought that LTV down to 40%. We haven't seen a huge amount of revaluation on that property portfolio, so the de-gearing has been largely through the introduction of new equity. 90% of our debt there is hedged with an average maturity of 3.4 years and the weighted average debt maturity of 4 years in Australia. There's good support from all investors for the Australian entity, and clearly as the South African parent company, we continue to see value in that operation and continue to support its growth aspirations. Good returns out of Australia, 21.1% total shareholder return for the 12 months to December 13, and a return on equity of 19% for the 12 months. V&A Waterfront. Net property income grew from 155 million to 172 million. And the property portfolio makeup on the right-hand side between retail, fishing and industrial, residential, office, hotel and bulk, you can see remaining fairly stable. KPIs at the V&A. Vacancies are negligible, 0.3%. Arrears at 23.7 million. Bad debt provision 9.7. There were no bad debts written off during the 6-month period. The average in-force escalations at 8, and the renewal success rate at 85.9%. The weighted average renewal growth at 6%, and the weighted average future escalations on renewals at 7. The number of employees, 177 people there, and the contribution per employee, 1.9 million. If we look at the different components of the V&A Waterfront, on the retail side, the new flagship Pick n Pay store has been opened, as well as the new Cross Mall, which resulted in the release of about 2,500 square meters additional GLA. Retail sales of the tenants in the V&A Waterfront grew at 15.2% year on year. You can see more than double the growth in turnovers that we're seeing from the rest of our portfolio. It's driven by 3 key elements, namely the good tourism numbers, improved hotel occupancy, and the weaker rand. I had to spend, or did spend, a couple of days down in Cape Town 2 weeks ago, and it was fascinating to see how busy the waterfront was with foreign tourists. So much so that on the one evening we tried to get into a restaurant, and we had to try 3 before we were able to be seated. And then it took us an hour and a half before we got our food. So I personally must say that I underestimated the impact of a weak rand on tourism in South Africa, and certainly on the impact of that on the waterfront in terms of the turnovers. If you look at January in isolation, January 2014 compared to January 2013, turnovers at the waterfront was up 27%. Vacancies in the retail at 0%, and trade debtors have reduced to 3% of monthly collectibles. On the office side, vacancies have also come down quite nicely, down to 0.9%. And this compares favorably to the CBD vacancy levels and is an indication that the V&A remains in high demand for its commercial assets. I think when we bought the waterfront, one of our key messages shortly after buying it was that we wanted to get the message across that the V&A waterfront is open for business, which I don't think it had been for the prior 5 years under the foreign ownership. And we're certainly starting to see the acceptance of that now in the letting demand that we're seeing not only in the office but also in the retail, but also for potential new developments for commercial office space as well as in residential in the waterfront. Alan Gray has settled in their new premises, with the old Portswood Ridge premises in the process of being converted to residential, as well as the Granger Bay office premises now fully let. So one of the risks, and it is reflected in this 6-month result, was Alan Gray moving out of the premises that they occupied. I think they occupied something like 9,000 square meters. They vacated the Portswood Ridge premises, and that is nearing completion, or the conversion of those offices to residential now is nearing completion. And those residential units will be held for rent, not for sale. And then also the Granger Bay offices, which is towards the let's say where the Breakwater garage is and the Aston Martin garage, the offices that Alan Gray used to occupy over there. Big risk there on reletting as they vacated, and we've been particularly successful in reletting that. 2 major tenants, I think Red Bull as well as EOH, have taken the bulk of that space, and we're only left with a pocket of about 400 square meters that remains unlet there. On the hotel side, across the precinct, hotel occupancies have improved dramatically, are performing well, clearly off the back of the weak rand and improved tourism, but also the major conventions that take place in Cape Town. So the mining in Indaba, you literally cannot get a hotel room in Cape Town when the mining in Indaba is on. The design in Indaba, which was there last week, similarly. and great spin-off to the waterfront from those events. We hope that we'll get some turnover rent from the hotels in the near future, given that the turnover rent pretty much dried up shortly after we bought the asset in 2011. On the fishing and industrial, the fishing and industrial revenue continues to remain strong. The marine activity for the period continued to be in high demand as the berthing facilities were fully booked for the peak periods. On the development side, in November and certainly more recently last week, there was quite a lot of news as well. At the Design in Durban, we announced the conversion or the intention to convert the old grain silo elevator building into a museum for contemporary art for Africa. V&A will spend in the order of 400 million rand on this building in partnership with Jochen Zeitz, who is a founder of Puma, the sports goods company, who has got a phenomenal collection of African art, and he wishes to exhibit this art in the museum. So his art collection will be the core art display in this museum on completion. He also has a curator who he's been working with for the last 10 odd years, a gentleman by the name of Mark Kutsia, and Mark will be curating this museum and bringing different displays and different collections to the museum. We'll also incorporate into that redevelopment a hotel, very high-end boutique hotel, only 27 odd rooms, as well as a new restaurant offering. We're redeveloping the old Blue Shed or Workshop 17, that's underway, and that should bring about an improved offering into the craft market and wellness center. Development is also underway for the completion of approximately 266 residential units in the Portswood Ridge and Breakwater precinct. So I mentioned the old Allan Gray offices which are being converted, and then in addition to that we're building brand new residential on top of the Breakwater garage, which is the old platform which was on top of the Aston Martin garage, that section of the waterfront. Again, these units will be held for rent. So on completion, we should have rental stock of around 266 units in the waterfront, and which will be the first time I think that we start showing some residential income from residential coming through the waterfront numbers. The extension to the Clock Tower parking garage to the South Arm Road is underway, which will expand current parking offering. And then the My City bus service, the first phase of that was completed in December, and phase 2 is due to be completed in mid-14. And having spent those few days in Cape Town a couple of weeks ago, I must say it looks like Cape Town have done a phenomenal job with this My City bus service. It really is a wonderful service. It's servicing it's a great commuter offering for Cape Town and Cape Town commuters. And there are a number of stops inside the waterfront, linking the waterfront to the city. On the property investment activities, very, very busy slide, but in essence we had an opening balance of 54 billion of assets in the total column, the closing balance at 57. Movement in between was purchase of or acquisition of properties in the South African business, about 407 million rands worth of acquisitions, 712 million rands worth of acquisitions in Australia, so combined 1.1 billion rands worth of acquisitions. Selling and disposals, we sold 488 million rands worth of properties in South Africa, nothing in Aussie. And then we spent 406 million rand on development capex in South Africa, 266 in Australia, total 672 million of development capex. The fair value adjustment at 1,104 million in South Africa. It's about 2.8% of the property value. 168 million in Australia. I think that number is slightly less in Australia as a percentage, giving you total fair value of 1.27 billion. And then we had the foreign currency translation reserve of 618 million in Australia, giving you the closing balance of 57.4. That includes assets that are held for sale or reclassified as held for sale, about 185 million rands worth of properties that we're in the process of selling. And then if we look at our commitments going forward, we've got 124 million rands worth of commitments for acquisitions. The development for the Discovery head office, as we mentioned, 1.437 billion. Other developments, 688 million, 85 of that in Australia. And then the ABSEC and Tiber portfolios, as mentioned, that has now already been settled. If you look at the office development pipeline, briefly on the Discovery project, we mentioned the 50-50 JV in terms of development, but the ultimate ownership 55-45 between us and Zenprop. Phase 1 of this development for Discovery is 87,000 square meters, and in 4 years' time, if I were to present from here again, I might be able to see it from here. So it's literally just up the road, up Rivonia Road, on the corner of Rivonia Road and Catherine Drive. We've already started demolition there of the old hotel that was on the corner. Further demolition to take place between now and I guess the end of the year, together with the starting to dig the foundations or the major. I think we go down something like 8 levels in the basement. The expected completion date, or rent commencement date rather, is the 1st of January 2018. It's a 15-year triple net lease with Discovery. We're targeting a minimum 4-star green building rating. Project value 2.9 billion and the projected yield at 8.1%. We've also entered into a JV down in Cape Town with the Rabi Property Group, 50% JV for the construction of a 17,000 square meter office building in Century City. We're in for half of that. The completion date is expected August 15. There we're targeting a 5-star green star building rating, and the project value is 423 million, where we are in for half as an equity partner, and we'll be funding Rabi for their 50%. Projected yield on that is 8.2%. And then the other major one is Ridgeside, which is a new office building in Umhlanga on the Umhlanga Ridge, a 6,700 square meter office development with expected completion in June 15. Project value there 149 million and feasibility yield at 8%. On the industrial side, strategies to extract value from the core portfolio through remodeling and redevelopment. And there's quite a list there of properties that have already been identified for that. We've also taken, as I mentioned earlier, a few land positions in addition. And we acquired 10 hectares of developable land in Wadeville, 8 hectares on the R300 in Cape Town, 6 hectares in Midrand, and 2 hectares in Blackheath, which is also in Cape Town. ABSEC and Tiber. ABSEC deal was 1.3 billion rand, the property valuation 1.3 billion rand. There was some net working capital of about 8.5 million. Their external debt was 940 million. So the NAV stroke purchase price of the acquisition was 396 million that we needed to settle in shares ultimately. The Tiber transaction, 6.2 billion. The number is a little bit less than what was previously disclosed, in that one of the properties had preemptive rights in favor of the tenant, which was the Massmart head office building in Sunning Hill. Massmart elected to exercise their preemptive right, which resulted in our total commitment reducing by approximately 400 odd million. Property valuation 5.7 billion. The value for the Manco was 350 million. Working capital 22.8. The external debt there was 1.5 billion. So the NAV 4.579, just short of 4.6 billion. And that was settled through the issue of 2.5 billion rands worth of shares to Tiber at 27 rand a share, and assumption of debt stroke cash payments to them of 2 billion and 60. There were 2 properties that Zenprop were in joint venture with Tiberon, and we've got an agreement with Zenprop to purchase the other 50% that Tiber didn't own, and that is a further commitment of 380 odd million rand. Again, similar deal to what we did. The terms of the deal are pretty similar to what we did with Tiber for that specific property, and we'll be settling the NAV of approximately 191 million through the issue of about 95 million rand worth of shares and a cash payment of about 97 million. A little bit of a story on those portfolios. So AppSec was made up of 17 properties. 13 of them were 100% owned. 4 of them were 50% owned and in partnership with Tiber. The Tiber portfolio was 36 properties, 25 of them 100% owned, 4 in JV with AppSec, 2 in JV with Zenprop, and then 5 were 50% owned where there are other third-party partners. The Zenprop, as I mentioned, are 2. So in total, we'll be taking on about 49 properties, as well as 68 employees, 8 from AppSec and 60 from Tiber. The total lettable area of these portfolios combined is just short of 400,000 square meters, 396,000. The vacancy for the portfolio is at 30,000 squares or 7.7%. The value per square meter for the portfolio as a whole comes in at about 18,755 per square meter. Forward yield of about 7.8 blended. Average enforced escalations 8.2, and the weighted average lease period 4.3. Just on that vacancy factor, I think it's important to note that in the Tiber number of 8.4%, there were 2 properties which we've categorized as essentially as industrial that were 34, almost 35% vacant. As we sit here today, those are almost entirely let. I think there's less than 1,000 square meters vacant on those properties. I think if we overlay the acquisition of the Tiber and AppSec portfolio onto the existing Growthpoint portfolio, and you look at the split by GLA for South Africa, which includes V&A and excludes AppSec and Tiber on the top, and which includes AppSec as well as V&A and Tiber at the bottom, about 19% of our GLA will be in the retail space, 19.9, call it 20%, 32% office, 47% industrial and fishing, and 0.8 other, which I think is residential out of the waterfront. And by value, 33.9% is retail, 47% office, 16.7% industrial, and 2% the other. Right, briefly then onto prospects. The risks are fairly similar, I think, to what we've been highlighting the last 2 odd reporting periods. You know, economic growth in South Africa is at a pedestrian pace. Last year we saw something like 1.9%. This year projections are for somewhere between 2.7 and 2.5%. We do see a slight weakening in the property fundamentals. Retail sales in particular, we see a slowdown happening there. We've already seen that come through in some of the retailers reporting results. 0 net new office demand. That's been consistent again for the last 3-4 reporting periods. And cost pressures remain, in particular with reference to the administered costs. The rising global as well as local longer-term bond yields clearly will impact our share price and the cost of our capital. But we've also now seen the rise of short-term interest rates with a 50 basis point increase in interest rates in January, prime moving up by 50 bips. So all things considered, we see higher cost of debt as well as equity funding that we need to contend with in managing the business and looking at opportunities going forward. Regarding opportunities, focus is going to remain on tenant retention and letting a vacant space. It's very, very competitive out there. So with the dynamic of pretty much no new net demand in office, it's a bit of a dog-eat-dog world out there, and we're just going to have to ensure that we get our fair share of any deals that's out there to be done. The fact, I think, that our office portfolio is mainly P and A grade is going to be positive for us, and we also see the industrial portfolio showing resilience. We do have a very exciting development pipeline, and we need to bed down these acquisitions, Tiber and Absec, which we believe are enhancing to the business as a whole, and certainly enhancing to distributions as well. We see a continued weakening of the rand versus the Aussie, certainly in the short term. The exposure to the hotel, to tourism, I beg your pardon, and the hotel sector in the V&A waterfront, as I said, we hope to see some turnover rental returning or coming our way from the hotel and leisure sector in the waterfront. And the waterfront is attracting new retail as well as office tenants. We've recently also been successful on another tender process for a major corporate looking to establish its head office in the V&A waterfront, more on the gateway, in the gateway precinct, which is that part of the waterfront which is closest to linking into the city. And then debt and equity capital remains available, albeit more expensive, as mentioned before. In conclusion then, on the distribution outlook, we're pretty confident that we'll be able to show 8% for the full year and continue on what we had achieved for the half year. We're not looking beyond the December year-end results, the June year-end results at this time, given that we're just in our budget process right now, looking forward to completing our budgets to the June 15 year. And we'll be in a better position to give you more guidance for the June 15 year at our year-end presentation. So that concludes the presentation, ladies and gents. Just on about an hour. Thank you very much for your time.